A very warm welcome to everyone. Myself, Mr. Raunak Bhattacharyya. Today, I discuss on the topic cash flow statement analysis. So, basically, it is a topic very important for the finance, very important for the business because cash is the most important thing for each and every business entity. So we easily called कि this is the mustering, the lifeline of business finance. Now, why cash flow matters in real business decision? Today, we are going to talk about something that keeps every company alive. Not profit, not revenue. Because in the first sense, we all think that profit is the main thing, revenue is the main thing, but the thing is cash. Because cash helps us to remit it all the obligations, daily meetings for business. So, over the next few times, we'll dive into the cash flow statement and learn how to read it like a detective, that is, just like a forensic accountant of a business, and connect it to the real world business decisions. For the explanations, we use some practical problems, some case studies, and some relatable examples. The second and the most important thing, it is a controversial topic, that is profit versus cash. It is a big myth कि why cash flow matters more than profit. So it is profit versus cash. So for the topic of discussion, some of you think a company is healthy if it shows profit in the income statement. Income statement reflects a good amount of profit, that means the situation of business is okay. Some of you think that a company is healthy if it generates the positive cash flows. So some of you think about the profit, some of you think about the cash flows, and some of you opt for the both options. So that's the exactly confusion that we shall clear today. So in a simple word, we may say that profit is a accounting magic, but cash is the reality. Profit is the accounting magic, but cash is the reality. So the question is that why cash flow matters? Why cash flow matters? Why do we care about cash flows? Because the company don't fail, they are unprofitable. They fail because they run out of cash. So profit is what you report and cash is what you use to pay your daily needs, salaries, paid to the suppliers, rent, loans, interest on loans. In each and every standing charges are met by your cash strength. So if you don't have enough cash, your business can collapse even if your balance sheet looks good. So that's why I mentioned that profit is just like accounting magic, but cash is a reality check. So this is the thing. So there are three financial statements. There are three financial statements. One is income statement, balance sheets, and cash flow statement. Income statement states how much money you made. Balance sheet states what you own and what you owe. But the cash flow statement is where the cash came from and where it went. So it is a flow of your business. It's may inflow of your business, it's may outflow of your business. So it is a flow of cash. So today's focus of discussion is the cash flow statement. So income statement means how much profit did you make? The cash flow statement is like the motion picture of your business. The other two are the still photos. Because the income statements and the balance sheets are prepared after the financial period of time, at the end of the financial period, financial year. But throughout your business, cash flow statement is maintained, and on the basis of the cash flow statement, you have to take the decisions of your dailies. So the thing is that cash flow statement is like the motion picture of your business, and the other two statements just like a still photos. It's not a videography. So one thing is stills and another thing is movement. So it is a controversial topic. Cash flow versus profitable statement. Next, there are three buckets of cash flows. One is operating activities, second, investing activities, and third, financing activities. So, operating activities, investing activities, and financing activities. So, there are three activities. So, that means there are three buckets. Operating activities means it focuses on the core business, the selling and the buying and the paying the stops and taxes. That means that your daily operations. So these activities actually focus on your daily operations. The investing activities focused on the long term investment, buying or selling the machines, land, buildings, or investments. So in a simple way, we mention the things of PL account and trading account are comes into the operating activities, and the asset portions except current asset. The asset portions except current assets is taking the consideration for investing activities, and the liability portion except current liabilities are the concern of financing activities. And the current asset and the current liabilities are always the concern of operating activities, because the portion of current asset over current liabilities, it is net working capital. So the financing activities mainly focused on the loans, on the equities, repayments of your debt, dividend, But remember, these are the structures. These are the structures of cash flow statement, and it will guide our entire analysis. Because we all the students of masters. So here we mainly focus on the analysis portion, not in the focus on the preparation portion. In our undergraduate level of studies, we have completed the preparation portions of cash flow statement. And today we focus on the analysis portion. How we analyze the cash flow statement. So it is just draw a simple diagram in your mind. There are 3 buckets, and just say try to map, and you shall read any cash flow statement. Now just give you an example of 2 cafes. So there are 2 cafes. It is an example, profit versus cash. One is Rohan's cafe and another one is Sneha's cafe. Just think, Rohan's cafe shows a profit of 50 lakhs. On the other hand, Sneha's cafe shows a profit of 20 lakhs. So on the viewpoint of profit, Rohan's cafe is in good positions as compared with Sneha's cafe. But Rohan's customer buy on credit and pay after 90 days. So it is a question of your working capital blockage. And Sneha asked for cash on delivery. So who has better cash to pay the rent, salaries tomorrow? Of course, Sneha. Sneha, even though her profit is lower, but this is why the cash flow is more important, more powerful than profit in the short run. So who will survive? Who will survive? As compared with these 2, Sneha will survive. And this is the question. This is to working capital, that is the receivables management, payables management, and the inventory management. All the things are depend on your working capital. So that's why this is a contradiction topic. Profit versus cash. Next, operating cash flow. So there are 3 buckets. I already told you there are 3 buckets. One is financing, operating, financing, and investing. So the operating cash flow basically relates with the heart of our business. It's compared with the heart. So the operating cash flow as compared with the heart of the business. Why? Because the operating cash flow is more important. It shows the business real value. It shows the daily operation of the business. There are 2 types of receipt. One is capital receipt, another one is revenue receipt. Capital receipt means it is one type of devaluation of your business. Suppose today you sell an asset. You earn some money. So it is an example of devaluation. But the income generates from your operating activities, that means it is a potentiality of your business. So the operating cash flow reflects the actual cash from core operations. If this is healthy, your business generating real value from operation. If it is weak, if it is weak, then no matter how good the profit looks, you are in trouble. Someone may say, so what? My operating activities is few lower, but I earn profit. But you all know, suppose you earn a good profit by selling of your asset, so that amount of profit must be recorded in the credit side of your profit and loss account, and that's why your net profit will higher. So your still pictures income statement, your profitability is high. But what is the reason behind this gimmick profitability? Selling of your asset. It's not good for your business operation. So if your operating activities is weak, no matter how good the profit looks like, you is trouble. So I just raise a question to the audience. If you had to choose only the section to check first, which one would it be? Of course, the profitability, of course, the operating profitability, the operating cash flows should be your first stop. When you check a thing on a particular business, at first you have to check the operating cash flow. I will show you an example of Suraj Tea House Private Limited. It is a business entity, private limited concern. So I just show a picture. It's an arbitrary picture. So the operating cash flow positive, investing cash flow negative, financing cash flow positive, and net cash position shows a positive. What does it imply? The operating cash flow 1.2 crore. So that shows a positive relation, that shows a positive effect of your business. That shows a positive effect of your business. So that means we easily conclude the business has a strong power on its core operation. But the other side, the investing cash flow shows a negative figure. The investing cash flow shows a negative figure means the outflow of the cash relating with the investment activities is more than the inflow of cash. That means the business invested a huge amount of rupees into the purchase of some assets. It may be machinery, it may be land and building, anything. It's a long term investment. So that means on the period of time, on the period of accounting cycle, the business invested a certain amount of money for acquiring the assets. And the financing cash flow shows 0.5 crore. So that means the business taking a loan. It may issue of share capital, it may issue of debentures, it may taking a loan from any bank. So the question is that the year-end cash flow shows 1.9 crore. So is this company expanding? This is my question. Because our today's topic of discussion, cash flow statement analysis, not the cash flow statement. So we have to analyze the statement of cash flows. So what does it implies? Is this company Suraj Tea House Private Limited, is this company expanding? The answer is yes. And what would you worry about if operating cash flow was negative? So the operating cash flows are negative means it is a red flag for the business. Here the business operates trading on equity. If the business taking the loan from the third party, and if the business issue the shares as the own capital, then the business is trading on debt. So here completely it's clear to all of us that business investing more money for acquiring the assets, business taking a loan, and business a positive sign कि it's earned 1.2 crore. So the year end cash 1.9. So the total cash inflow 1.9. Out of 1.9, 1.2 generates from the operation. It is more than 50%. So it is good for the business. The total cash flows, out of the total cash flows, more than 50% cash flow earns from the core operation. The operating cash flow is a dig into the operating cash flows. The operating cash flows here in details, the operating cash flows takes the net profit, because it is the results of the business operation, and some adjustments are here, that is the non-cash items, thus like depreciation, changes in working capital, receivables, inventory payables. If any time your operating cash flows is lower than your net profit, if any time your operating cash flows shows that the lower than the net profit, it means your cash is in stock, in receivables or inventories. A business shows a net profit, so that means business earns, but the operating cash flow is low, so that means you earn, but your cash is not recovered, your cash is not come out. So it means cash is in stock, in receivables or inventory. So it is a examples of poor inventory management. And if it is higher, it means you are collecting efficiently and managing the payables well. So you collecting your all the receivables from your debtors, and you easily manage to pay your all the creditors. So we use a simple formula कि operating cash flow must be equal net profit plus non-cash items and plus minus changes in working capital. Net profit, non-cash items, and the plus minus change in working capital. Because we all know कि add decrease in current asset, less increase in current asset. So why we add decrease in current asset? So current asset decrease means you received your liquid cash. Suppose on the beginning of the year my debtor balance shows 50,000, and the end of the year my debtor balance shows 30,000. So it is an example of decreasing debtor. So debtors decrease from 50,000 to 30,000, that means 20,000 debtors is recovered. So I received 20,000 amount during this accounting period from the debtors. So that's why we add. Next, I will show you another example. Is a real scenario, that is garment company. Because these subjects, our finance is a very practical subjects. Finance is everywhere. If you cut your hand, a blood comes out from your hand, and this is the finance of your body. The relation of blood with our body just like as same as the relation of finance of a business entity. So finance is everywhere. So that's why we discuss again and again, one after one another, practical examples. The practical examples, it is a garment company. Situation: boss wants to repay 12 crore loan next month. Boss wants to repay 12 crore loan next month. But at that time, net profit 10 crore, operating cash flow 3 crore, and loan due 12 crore. So can the company repay, or is it a good wise decision to repay now? This is our point of discussion. Okay, our net profit shows 10 crore and the operating cash flow shows 13 crore, 3 crore. That means 13 crore available and the loan due only 12 crore. So okay. So can the company repay in this situation? Imagine you are a finance manager at a garment company and your boss says this. Can we do it? So just think, the net profit 10 crore, operating cash flow 3 crore. Why? Receivable increased, inventory increased, cash is tied up. So as a CFO, what would you ask the sales and the operation team? There is a two questions. These are two questions. The answer is that this is a situation for repay. The entire amount of loan is not good. Simultaneously, you suggest to the sales team, to the operation team, to earn a more amount of profit, to earn a more amount of revenue from your daily operations. And you have to suggest the credit policy of your business, because a huge amount of money are stuck in your business and the collection terms may not be good and the inventory policy is not up to the mark. So that's why the company can't repay the loan right now. Why profit not equal to cash flow? Why profit not equal with cash flow? This is a question and it is a controversy. Customers are paying slowly, so that's why the receivable increased. In the other side, inventory piling up, not yet sold. Credit sales recorded as a profit, but cash not received. Credit sales are going on. The sales value, the credit side of the trading account is higher. Gross profit will high, as well as net profit will high. But the cash is not received. So that's why it is an example of very poor collection management. Collection management. If you were the CFO, what question would you ask? Number one, you can ask, why are the customers taking so long to pay? Do we really need this much inventory? Can we tighten the credit terms with this situation? So this is the questions as a viewpoint of the CFO. All the questions are analytical. Why the customers taking so long and to pay? Because for this reason, cash management is being poor. Suppose I will show you a funny thing. There's a fun analogy. It's very interesting. Just think your salary versus your bank balance. It is a funny example. Just think about the salary and your bank balance. Profit versus cash. Think of as your salary on your paper, and the cash flow is the money in your bank account. So you can have a high salary but still be broke if your expenses are high and you don't manage the inflows and the outflows. Your salary is high, but you don't have to maintain the income expenses ratio of your life. So similarity, a company can took profitable but run out of cash. So that's why I mentioned this term कि cash flow is your reality check at the beginning of our today's class. Now we focused on the investing cash flow. Investing cash flow means it is a investment in long term. That is a building of a future. Investing cash flow shows how the company invests in growth, purchase of machinery, land, building, acquisition of the other companies, R&D, investment, technologies, etc., etc. These all is in the futuristic concept. So investing cash flow means it is a choice of today that shape tomorrow. It is a choice of today and shape tomorrow. Investing cash flow shows how the company is building or destroying its future. Either building or destroying. A negative investing cash flow often means buying machines, buildings, or investing in R&D. It's good for long run. A low and positive investing cash flow means the company is not investing much. So the question will come, in a company that's investing heavily, would you expect in short term its pain or long term gain? It's a most tricky word. In a company that's investing heavily, would you expect short term pain or long term gain? So what is the answer? So when a company investing a huge amount of rupees in investment, So it is a short term pain, because the company invested a huge amount of rupees into the investment. So the proprietor doesn't enjoy the entire amount of rupees out of the profit. So it is a short term pain. But today's pain is tomorrow's gain. So that's why it is very, very wise decision to invest a certain amount, to invest a low amount day by day. It may today's pain, but in long run, because business is a perpetual succession, is a going concern concept. So in long run, it earns huge amount of profit. In long run, it earns huge amount of gain. So the short term cash outflow means the long term growth. Today's cash outflows, short term cash outflows means you gained in long term. Next, there are two investment strategies, company A and company B. Because before starting today's discussion, I mentioned you कि I will show you more and more one and another after examples, because finance is a practical subjects. So there are two type of investment strategies. So it is an arbitrary example for company A and company B. Company A, high investing in cash flows, cash outflows, building the future growth. And company B, in the other hand, zero investing, cash flow, risk or obsolescence. So if we compare two companies, a company A is a high negative investing cash flow, the strong operating cash flow, and the company B, zero investing cash flow, that means the good profits. So which one is more future oriented? Of course, company A. Company A, which one may struggle in 5 to 10 years? Investment is just like a planting a tree. Your investment is just like a planting a tree. You don't see fruit today, but you will tomorrow. I will tell you an example of Japanese bamboo. It is a very, very practical examples and with funny examples. If you planted a Japanese bamboo tree, you today plant a saplings. You provide some foods, the necessary foods, lights, water, daily, but growth will not discovered. After a month, after a year, 4 year, 5 year, 10 years, the size of plant same. But the plant collect the sources, huge powers on the below the earth. And when he will just gear up for the growth rate is huge. Within a week, is convert into 5 to 10 feet. Within a month, 20 to 30 feet. So this is a funny example, but it is true example of Japanese bamboo tree. So investment just like a planting. You plant today, but no fruit, but you will get tomorrow. So this is very, very important and very, very interesting things. So I just ask to the audience, if you were investing for 10 years, which would you pick? Company A or company B? Think and then mention your answer. But just try to emphasize that negative investing is not always bad. Negative investing is not always bad. High negative investing but with a strong operating cash flow is very, very good. But zero investing but good profits is not at all. It's at all good for your long term benefits. So we successfully covered the first on the three bucket, among the three bucket, covered the two buckets already, that is operating cash flow and investing cash flows. And now we just focus on the financing cash flow. So what do you think about financing cash flow? It is a financing part of finance. It is financing part of finance. That means it is a fueling the engine. Financing cash flow means how the company is funded. Financing cash flow shows how the company is funded. Positive means this huge amount of loans, equity, issuance. Negative means repayments of loan, paying the dividend. If financing cash flow is consistently positive, it may mean the company relies on the external funding rather than the internal profits. If financing cash flows shows a continuous positive figure, that means the company always focus on the outside fundings. They never reinvestment out of the profits. They always realize on the external fundings. The question is that if both operating and investing cash flows are weak, if both the operating and investing cash flows are weak, and the financing is the only source of cash, is that sustainable? The question is that. It is very important question, very tricky questions. Ki day by day, the other two cash flows are weak and the business only funded from the financing activities. Is it sustainable? No. It's a red flag again. This is just like it's a depending on your parents. You invest money from everywhere. You purchase mobile, you purchase laptop, you pay on club, pubs, etc., etc. But what is your source of income? From the pocket money. And you collect it from your parents. So it's not good. It's not a good gesture. It's not a good habit. If you want to enjoy your life, you enjoy. But if you just taken the money from your parents and you just enjoy, so it's not good. So it's just an example. So that's why financing cash flow is very important. I will show you another example, that is a startup story of a person, Arjun's journey. A startup story. Cash flow type 1 to 5. Operating small negative to small positive. Investing heavily negative, burning cash. Financing strongly positive, VC funding. So is this a story of future value or is the story of future failure? Think. Because it is a practical subject. On the on your perception, on your thinking, answers may be different. We all know finance is a combination of arts and science. So, on the basis of the situation, on the basis of the positions, your decision might be different. So, I will show you an example. What does it imply? So, it is a startup story. So, meet Arjun, a startup founder. And for the first 5 years, the operating cash flow shows sometimes negative, sometimes small positive. So, that means the core operation is not in the boom stage, it may be in bond stage, not in the growth stage. Investing cash flow is highly negative. That means Arjun invested a huge amount of rupees for acquiring the assets. Financing cash flow is strongly positive. So that means he collected fund from everywhere. Everyone says he is losing money. But if the operating cash flow, because the operation is the main thing of your business, so if the operating cash flows is improving over the time and he is using the financing to build up the business, that is a story of future value creation. So our comment is on the decision, on the situation. And if you were an investor, would you rather fund a stable profitable company or a fast growing company? If I am the investor, I always invest on a stable funded company. So, this is a good place to talk about the venture capital mindset. Basically, cash flow is a tool of financial statement analysis. So, using the cash flow statement, using the ratio analysis, we easily analyze the financial position of a business entity. So, that's why cash flow is very, very important for us. If you were a banker, what would you more? What you do worry you more? Negative operating cash flow or negative investing cash flow? Think. It is basically, it is a concept of trend analysis. Trend analysis means it is the concept of power of time. Always look at cash flow over 3 to 5 years, not just 1 year. Don't judge a company, don't judge a business entity on the basis of the particular year. Because on the particular year maybe happen any type of abnormal gain, any type of abnormal loss. So always follow the trending. What would be the trend? The trend is ascending or descending or fluctuating. For example, if operating cash flow is year 1 5 crore, year 2 3 crore and year 3 1 crore, 5 crore, 3 crore and 1 crore. So that means this is clear to all of us, and it is a warning sign. Even if the company is still profitable, it's not good for investment, because the core operation, the core process, the core operation is diminishing. So if the company is profitable, so that means it is a portion of disinvestment. So it is a suggestion for customer growth, suggestion to check the cost structure, it is a suggestion to revalue the working capital policies. I just suggest. Because when you are hired as a finance expert of a company, then you just analyze the cash flows of the company and you will take the decision of the company. You are the key managerial person. So that's why cash flow statement is very, very important. There are many examples. These are examples of restaurant chain. Year 1 0.5 crore, year 2 0.3 crore, year 3 1 crore. This is good? No. Diminishing, decreasing. So it's not good. This is the trend analysis. Now I will show you another example. The financial data of Digital Bazaar. Net profit 15 crore, depreciation 4 crore, increase in receivables 6 crore, increase in inventory 8 crore, increase in payable 5 crore. So net operating cash flows 10 crore. Operating investing cash flows 12 crore and financial cash flows 8 crore. Net increase in cash 6 crores. So the data is given to all of you. Analyze. So again the data: net profit, depreciation, increase in receivable, increase in inventory, increase in payable, net operating cash flows, net investing cash flows and net cash. Now is the time of analyze. Here the question 1: why is the operating cash flow 10 crore when the net profit is 15 crore? And the question 2: if this pattern continues for 2 to 3 years, what might happen? So let's clarify one after one. Firstly, higher receivables and the inventory, that means the cash out, and the higher payables mean the cash in. So this is examples of shortage in cash. So the operating cash flow is 10 crore and the profit is 15 crore. So that means the working capital kills the cash. In Digital Bazaar, the difference between profit and cash comes from the working capital changes. Increase in receivable means more cash tied up, and increase in inventory means more cash tied up. Increase in payables means cash saves. So if you could change only one of these three, which would you choose to improve the cash flows? So it is an example of miss cash management. A huge amount of cash stuck in the business. So collect receivables faster and manage the inventory tightly. It is a lack of receivables management. And you can mention for the policy reformation on the credit terms and better forecasting. And if the pattern continues for 2 to 3 years, the Digital Bazaar will face a big challenge, because in the upcoming future they just are out of cash. working capital tends to nil. So they will not meet up their daily expenses. Now we come at just the end of our today's discussion. This is a pro analysis checklist. If you just appointed as an financial expert, how to analyze like a pro. So here's a sample checklist to use in your real life. At first, check the operating cash flow trend over 3 to 5 years to find out the trend of the business. Next, compare the operating cash flow with the net profit. 3. Analyze the investing cash flow and is it growth or wastage? Next, study on the financing cash flow. Is the company is dependent on debt or the equity? Because the financial cash flow reflects the true picture of trading on equity or trading on debt. And always ask why, not just what. As a financial analyst, try to ask the why, try to find out the causes, not just what. And if you had to pick only one item from this checklist, which would be the most important? The most important is operating cash flow, because it is the operation of the business. On the basis of the operation, you should invest. So the operating cash flow, the value of the operating cash flow is number one. So you first emphasize on operating cash flow, try to trend, and then it is your takeaway tool. So always focused on why, not just what. So just think, this is your business, a small shop. Monthly sales 1 lakh, monthly expense 80,000, monthly profit 2 lakh. But there is a twist. What is the twist? Two payment scenarios. One is customer pay immediately, and scenario 2, the customer pays after 60 days. Compute the cash at the end of the month 1, month 2 and month 3. Which scenario has less cash stress? So basically, in the group 1, the customers pay immediately, and the group 2, the customers pay after 60 days. So basically, what the game teaches us, in group 1, cash grows smoothly. In group 2, cash can be negative in early months, even though the profit is the same. So that is the difference between profit and cash. 1 hour before, I told you that profit is the magical figure. Profit is the financial magical accounting. It is a still picture. But the reality is cash. So this shows that the timing of cash inflows is as important as the profit itself. In real business, many companies fail because they don't understand the timing of the game. Sale okay, profit okay, but cash management is not up to the mark. So many companies fail because of this. So at first, emphasize that cash timing is a working capital management skills. It's very, very important. Now, is a real example of Tesla. It is a real example of Tesla. in 2023. What is the example? It is strong operating cash flows from car sales, heavy investing cash flows in a new factories and R&D, positive financing when raising the capital. Despite low profits in early years, Tesla's cash flow from operation grew consistently. So just my question is that if you see a company with strong operating cash flow and heavy investing, would you call it risky or promising? This is my question. So it is very promising. When a company shows a good cash flow and using the money from this amount, the company is invest. So it is very, very promising. Because the company earns out of its core operations and the company planted the money today for future fruits. So I always prefer this type of companies. Next, I will show you another example of Reliance Industries. Operating cash flow 1,42,000, investing cash flow 1,09,000, financing cash flow 33,000, net increase in cash flow 374 crore. So it is a strong operating cash flow plus heavy investment. It is a growth story. But you will often see large operating cash flow from refining and petrochemicals, heavy investing cash flow in new sectors like telecom, financing cash flow used for the growth and debt repayment. So for an analyst, this structure tells a story of continuous transformation across the industries. So it is an example of continuous transformations across the industries. So these diversified giants use the cash flows to the shift strategies. So the truth, you need all three statements, but if forced, choose only one. Cash flow statement should be your favorite. Now is a final question. If you had to choose only one, the statement to analyze a company, income statement, balance sheet, cash flow statement, which one would you pick? Silently choose one. Now the truth is, you need all three. If you want to explain, if you want to write up a detailed view of a company, so then you pick all three. But at a glance, you just make a slightly. So cash flow is the finest statement, and in the cash flow, the operating cash activities is the most important and rank 1. Why cash flow wins? Today's discussion is cash flow statement analysis. That's why cash flow statement wins. No. No. Because a company can survive being less profitable but it can't survive running out of cash. Cash flow wins is not for the today's discussion is cash flow. Cash flow wins because a company can survive being less profitable, but it can't survive running out of cash. So thank you for your patient hearing, and if you have any questions, just mention on the comment box. Thank you so much.